Hi, everyone. Today is June 10th, 2021. This is Natalie Pace, and thank you for joining me. We're going to be discussing today exit strategies. So, you probably have been hearing that inflation is really going up, and maybe with stocks at an all time high, you're worried about that. So, what do? What's your exit strategy? Should you try to just jump in or jump out? Or are you afraid that you'll miss it if stocks keep going higher? Well, there's a simple strategy for that. Also, what about crypto and cannabis and technology and biotechnology and some of the hot areas that we're seeing? What should you do about that? Should you be buying, capturing gains, selling, jumping in, jumping out? There's a strategy for that. So let's discuss all this and more in including the macroeconomy, hot industries, industries that are not so hot that you might think might be hot. And we're going to do all that in just a moment. I'll be right back. Okay, everyone. So in today's exit strategies video conference, we're going to cover a lot of ground. We're going to talk about our nest egg or our retirement accounts, but we're also going to talk about hot things like crypto, cannabis, technology, biotechnology, gold, if you're into that as well. And the strategies are slightly different, but they stem from a fundamental thing that we should be doing. We should all be making sure that our investment strategy is properly diversified, that we're keeping enough safe. And if you are worried about the economy, then you might be overweighting safe, or valuations, you might be overweighting safe. But another thing that you must do is you must rebalance. So the first thing we're going to talk about is that it can be very confusing out there. I had someone in one of our last calls said, I have a quant guy and he's saying that bonds are up 40%. Well, that's a little bit misleading. It can be accurate, but misleading, because if the average return of a bond is 0.2% and it goes up 40%, it goes up to 0.28%. So that's still a quarter of a percent. That's still very, very, very low. So yes, it can increase 40%, but that's still not much money that you're getting paid, because the amounts that we're talking about are teeny tiny increasing to teeny tiny. Okay? So far different than cryptocurrency that started the year at like 10,000 and went all the way up to 60,000, well, actually about 65,000, and then now is down to 35,000. That is big jumps. But of course, if you bought high, you're down a third. So what do you do in that environment? Well, again, if you're using the pie chart format, it allows you to get hot. It actually prompts you to sell when you get too hot, and it also protects you. So let's talk a little bit more about the basics, and then we're going to drill in a little bit more to the hots, because those do require a little more babysitting. All right. So a lot of people do not know what they own. And that's where we have to start, is you got to start with what you own. And this is somebody's portfolio that I just recently did. It's anonymous. And it's very indicative of what I see over and over again. If you have a managed plan, or if you have a 401k or an RSP, and you don't really know what you're doing, many times you do not have enough safe. So let's say this couple was 50 years old. They would only have 22% safe, their cash and their bonds. And that means that they are basically acting as if they were 22. If you're 50 or over, then you have to protect some of your wealth, because the last recessions have been devastating. And if it takes you 10 years to make up half of your money, you really don't have that. That could prevent you from retiring. You could lose your home, honestly, because your asset value goes down, your FICO score goes down, and life becomes very problematic during that recovery period. The other problem with it is that if you lose that much, you have to use the bull market to make up losses. Whereas if you keep enough safe, then you have the liquidity or the money to buy low. So I think it's really important to remember that the reason that people don't buy low, they can't buy low because they've lost too much money and now they have to hope and pray to make up for the losses. So this particular couple, again, they just didn't know what they owned. They had over 200 different holdings. They had a managed plan and they didn't know what it added up to. I looked at it all and this is what it added up to. Now, when I say something as easy as a pie chart, you might say, well, that pie chart doesn't make sense to me. I don't know what to compare it to. Well, I have a simple web app. It's on the homepage at nataliepace.com. All you have to do is click on it and you'll receive an email with a link to do your own, to mock up your own sample pie chart. So this particular person, 50 years old, about 1.6 million in their nest egg, and they're making about $250,000 a year. So what they're supposed to have is about $80,000 in the slice and about 812,000 safe. As you can see, they're very short on how much they should have safe. And if they're supposed to have about 80,000 per slice, they have way too much large cap growth and large cap value. They don't have enough of their small and their mid caps. They have, maybe a slice and a half of gold, but most of their hots, they don't have enough of them. So again, if you know what you should have and you know what you do have, then all you have to do is sell high in the slices that have gotten too large and buy more in the slices that have gotten too small. That's a buy low, sell high plan on autopilot. And by the way, if one of your slices was cryptocurrency and you bought it, say at 10,000 and it goes all the way up to 60,000 and you now have 6 slices, then it's telling you, you know what, I don't want 6 hot slices of crypto. I'm going to sell high. And if you did that and you took 50,000 off the table, and then it went down by a third, so now your 10,000 slice you still have in crypto went down to 6,700-ish. That gives you both the money, the gains, and the emotional fortitude to buy more low. So you could go back in and buy another 3,000 of that Bitcoin if that's what you were interested in, or whatever other cryptocurrency you were interested in. Again, we're going to drill into crypto more, but I want to stay on the big vision for a little bit longer because these slice system is what's going to help you to buy low and sell high. So again, when the slice is super big, it's telling you sell high and get more safe. When the slice is too skinny, like the technology slice is almost the right size. Biotech's too small, cannabis is too small, and it looks like they don't have any crypto. So what else you can do is I do have a blog about rebalancing. If you need the exact link to it, just email us at info@nataliepace.com. And it just asks you to take this rebalancing nest egg test. So there's just a few questions here and see how you do. There is a link to all of the answers right there at the end of it. So if you do this and you follow those steps, you're going to be, basically protecting and diversifying. So that portfolio that we looked at wasn't properly protected and wasn't properly diversified. Now I looked at another one and I want to show you a sample of this one as well. Second, it's this one. So this person was very conservative. And so their broker had them in bonds and annuities. And what this person didn't know is that they were actually in junk bonds too. And they had too much large cap value and no small, medium, or hots really to speak of. A little bit of clean energy, a little tiny bit of technology. Now, this person's portfolio and age was very similar to the last one, so about 80,000 per slice. So you can easily see that large cap value should be trimmed back, and then they need to start putting in some of the other stuff. I wouldn't consider junk bonds a hot, so I would get rid of that one. But the other thing is you also have to know what's safe in a world where over half of the S&P 500 is at or near junk bond status, where bonds are losing money and giving you very little return for the amount of risk that you're taking on, where bonds are illiquid. And by the way, the feds are going to start selling off their bond portfolio, which could be making this market even slightly more illiquid. So it's really important for you to know what you own and know what's safe. Read the bond section or the what's safe section of the ABCs of money at minimum. It also might be a good idea if you have a big portfolio to get a second opinion from me or to join us at our October retreat. I'll just say real quickly that you can get additional information about our October retreat on the homepage at nataliepace.com. If you just scroll down, you'll find the October retreat banner ad. And if you click on that, it takes you over to give you additional information. One other thing I wanted to point out, if you look at the pricing, right now we're in the early bird pricing period. And if you register by Sunday, in addition to the lowest price, you also receive a complimentary private prosperity coaching session valued at $300. So it is worth it if you've been thinking about attending a retreat to get registered by Sunday. It's also worth it to attend an online retreat, especially if you want to bring family members, because these prices are a lot lower than we're able to offer for our in-person retreats. So October is another online retreat. And when you want to bring a family member in the early bird period, they're only going to pay $350, which is half the price. That is a price we're never able to offer in the in-person retreats because our costs are higher. So it's, and by the way, my youngest volunteer is 12. She's been to at least 6 retreats. So tweens and teens love learning what we're going to talk about next, which is picking shoot the moon stocks. So let's talk a little bit more about shoot the moon stocks. I think one of the things that's really important to realize is, as my son put it, the crazies are talking about it, so it could go crazy high. He didn't want to sell yesterday. He had one of the meme stocks and it went on the big bulletin boards. Everybody was talking it up and it doubled in one day. And he didn't want to capture gains because he thought it might go up 10 times. And it's a valid thing because we did see this community take GameStop, which was on the ropes and almost into bankruptcy, from $4 a share to $483 a share. Now, let's talk first about cannabis because we've seen a lot of activity this week in cannabis because the House of Representatives reintroduced the MORE Act, and Chuck Schumer is promising that, I believe it's here. Yes, Chuck Schumer is promising that the Senate is going to add cryptocurrency to the agenda as well. So what we have seen is a rally in one cannabis stock, but not all. So I do recommend that you read this blog. Will cannabis be decriminalized this summer? It's the most recent one. As you can see, I just posted it today. And what we're seeing is that Tilray is the one that seems to be going up. Some of them are flat and some of them are slightly down. And Tilray is a meme stock. So as you can see, people want to push it all the way to 420. It's at $20 a share right now. And if you think that's crazy, well, they did $4 to 483 with GameStop. So this is one where your one hot slice might become 10 hot slices or more. So what do you do with that? Well, you want to have, again, when you're dealing with individual companies, and in cannabis, I do think that's a good idea because, you can't really get like a well-established high credit rating fund company that's offering you a cannabis fund yet. You're going to have to go with MJ or Toke, and they're not offered by these well-capitalized long-term companies. So I would, and another thing too is that they're not all created equal. So my 2 favorite cannabis companies have been Tilray and Apria. and they just merged. So now we have one Tilray that's actually Tilray and Afria. So do read that blog on that. But what's your exit strategy? I think that what we've seen with cannabis is that when a country decriminalizes, and when the US decriminalizes, it's going to be big news. And of course, it's an if, but if it happens, usually the run up happens before the actual vote. So once everything gets added to the agenda, we could see these stocks shoot the moon, particularly Tilray, which is all over the bulletin boards that Gen Z and millennials are reading. So your strategy would not be setting a limit order for when it doubles, because this is one that really could shoot the moon. It might be a better strategy for you to keep an eye on the agenda for Congress and see when the House is going to put it to a vote. When is the Senate going to put it to a vote? And just understand that both when Canada and when Mexico decriminalized, both times, the stock rallied before the vote, and after the vote, it actually went down significantly. Now, this is a company and an industry that's kind of coming out of the shadows. I mean, it's obviously been around for a very long time, but it's being legitimized and becoming a business now. So these companies, especially the ones that I think are leaders like Tilray, they really can have a good future, but they're not buy and hold stocks in today's environment because of the macro environment, because these shoot the moon stocks overshoot the valuation. As an example, Tesla was a company that had only $1 billion in sales, and it was valued at almost $900 billion in January. That's just too pricey of a valuation. And since then, we've seen Tesla drop significantly. Now, it's still pretty high price and it's still got a pretty high value. But it's important to realize that these meme stocks, they shoot the moon and then they can crash. So they don't always stay on the moon status for that long. Now, another thing is crypto. So I get a lot of people that say, I'm buying crypto and I'm going to hold it because Bitcoin's going to be worth 100,000 easy a coin. Well, that's not really what's happening with crypto. And a lot of it's not a buy and hold thing. It's not a currency yet. It can be. I'm not saying that it won't be. I'm saying what it is right now. What it is right now is, in the famous words of Elon Musk when he was on Saturday Night Live, it's more of a hustle. So it's a speculative trading thing. It doesn't mean that there aren't very good fundamentals behind cryptocurrency. It just means that right now, when you have these wild swings in it, it's not being used as a currency yet. And if it does go to $100,000 a coin and only a few people have that, it still isn't really a currency, because a currency is something that everybody can have access to. So what do you do with that? I think there's an important thing to show you, and I have a couple of charts I want to pull up for you. So just one second, let me share the screen. So as an example, here's the Bitcoin trading chart. If you were to buy Bitcoin, and if you look in the bottom right-hand corner, you see that the average hold time is only 54 days. So all those people that are saying that they're buying and holding, that's not what is really happening. Most people are trading it within under 2 months. And if you look at Ethereum, you're going to see the same thing, 46 days, so even shorter. If you look at Cardano, 27 days. And if you look at Dogecoin, it's going to be even shorter, 5 days. So again, these are speculative. It doesn't mean that it's not worth a hot slice. What it does mean is that it is not a buy and hold idea at this point. It's not yet going to be currency. So for you, if you're going to have something that's super hot like that, limiting yourself to a slice or two. So mocking up that personalized pie chart and knowing what a slice is of your portfolio, the exact amount, and then saying, okay, I'll have 1 or 2 slices, at most 4 slices of cryptocurrency. And if those 4 go to 8, trim them back down to 4. What that means is that you get to keep, so if you've doubled your money, you're going to take all the gains off the table and you're going to put them, you get, your wealth gets bigger, but you keep it. And that way, if it goes down and takes a dive and you still believe in it, you can buy more low and probably still have kept a lot as well. All right, so what about gold? Because gold and silver are in a rally as well. So again, when we're thinking about when we take our profits and what our exit strategy is going to be, if we're using the hot slice in the pie chart system, whenever it gets to be, too big of a slice, you can make a case for trimming it back to where it should be. But it's also a good idea with the hots, not as much so with the small, medium, large value growth, the ones that are predicted to grow more like the markets grow. The hots are ones that are supposed to be shoot the moons, right? So with the hots, it does pay to understand what is underneath the due diligence, what's underneath this particular hot. So with crypto, what's underneath it is that it's just super popular and everybody thinks, honestly, it is like millennial and Gen Z gold. When they lose faith in the dollar, they become very interested in cryptocurrency. When boomers lose faith in the dollar, they become very interested in gold and silver. I'm an and person, I have a slice of each. So what about gold and silver? Well, what we know about gold and silver is this. In addition to when inflation rises, people like gold and silver. Also, when they lose faith in the dollar, they like gold and silver. So the last time that gold hit its all-time high, it's higher now than it was back in 2011 when it hit 1895. But the last time that it was this high was when the US credit was downgraded by Standard & Poor's on August 5th of 2011. So the gold hit its high in September of 2011. So we do actually have a negative outlook on our credit rating from Fitch Ratings. Now, again, since they already gave us a negative outlook, they don't give us warning. They're just going to downgrade us or they'll take that off. One of those two things. Usually it happens within an 18-month period. That would mean sometime between July and December of 2021 this year. So that's something to keep your eye on. Now, the good news is the US is expected to grow gangbusters year. It's a recovery year. It's already priced in, so don't get too crazy about it. But that's good because that means that it's possible we won't get the downgrade. Most people think there is a likelihood that we'll get a downgrade in our credit because we printed up over $5 trillion to get us through the pandemic. So with gold and silver, what I would say is that, wait and see if we get that credit downgrade before you trim back, before you do your rebalancing. Now, with technology, it's interesting because when we start looking at technology, it's hot. I mean, these companies are doing very well if you look at their sales, but it's already priced in. So Tech B has a lot of our most favorite companies in it, but look at this price chart. It's trading at an all-time high. The biotechnology, same thing. It's trading at an all-time high. So again, this is one where if you have a hot slice, maybe you're trying to ease into it. Maybe you put a toe in the water or go in up to your waist. I wouldn't just buy high just to have those hot slices, even though they're super hot, because they are also very, very expensive. Be like paying $25 for an avocado. So what do? There's actually a few biotech and technology companies that are hot that are not overpriced. In fact, my company of the year is one of them in the biotech industry. So take a look at my company of the year blog, the 2021 company of the year, so that you'll know which company it is, Moderna. And what we see is that with Moderna, its growth is 23,000% revenue growth year over year. So last year, it made under $1 billion and it lost almost the same amount. This year, it's expected to make over $19 billion. And so that puts its price earnings ratio forward price earnings ratio at under 9. Right now, stocks are very expensive, and the average price to earnings ratio on Wall Street is about 37. That's really expensive, guys, because on average, we usually get about 16 or 17. So having the average on Wall Street be 37 means that you are paying $25 for an avocado. It's pretty pricey, it's pretty outlandish. And then you have the hottest company on Wall Street, and it's going to have a 9 forward price to earnings ratio. So even though Moderna is trading at an all-time high, this is one that actually could be a decent purchase for you, again, in your HOTS. So when we're talking about these different hot slices that you can have in your nest egg, the HOTS you got to babysit a little more, and you do want to think about what's driving the heat, what's putting the heat on the firing the heat. With the rest of your nest egg, you just have to rebalance it once, twice, or 3 times a year. Now, if you haven't rebalanced ever or in a long time, do it now because stocks are high. You're going to feel great. Fix the roof while the sun is shining. It's a lot more difficult to fix it when you've lost money. It's great to fix it and keep your money when stocks are high. So now's the perfect time to do it. Now, let's also talk about real estate because I have so many people, especially millennials and Gen Z, that want to buy something because they look and they say, you know what, I could buy something for the same amount I'm renting it. But the truth is, the people that are telling them that aren't adding up everything for them. So, what we're seeing, sadly, is that over 2/3 of millennials are regretting the purchase after it happens. I think it's right here. And this is why. So some of them are finding out that their maintenance costs a lot more than they realized, especially if you have a condo. Others are realizing that their mortgage payment is more than they can afford, and they're unhappy with it. Others think that it's not a good investment or that they overpaid. The one thing I can tell you is this: overpaying for real estate is one of the worst mistakes you can ever do because it will be hell for you. It can take your FICO score and throw it in the toilet if the market goes down. You're stuck there. The banks are not very forgiving. So it's really important when you're thinking about purchasing real estate. Can I afford this? How does it fit into my Thrive budget? And honestly, it should not be more than 28% of your budget. And that should include the maintenance costs, all the costs of your housing. Also, right now, if you already own and you're feeling equity rich, don't rest on your laurels. Do the math. The last time real estate went down, it dropped by half. And right now we have about 5 million people that either haven't paid their mortgage or haven't paid their rent. So there's a lot more distress in the market than people are saying. And that some of that inventory is expected to start hitting the market as early as October. So be careful about that. Now, if you're a homeowner that's underwater and in trouble, then reach out to our office because there might be ways that we can help you. You could also read, I have a real estate section in the ABCs of Money. And there are many case studies there to help you decide what's going to be best for you. So again, on the ABCs of Money, just go to nataliepace.com. And if you scroll down, you'll see my books and click on it. The ebook is under $5. And again, there's an entire section on real estate. So whether you're equity rich, underwater, or want to buy, you should be looking at that. Now, having said that, I think that in a high debt world, such as we have right now, that in hard assets can hold their value going forward. So I would not necessarily just sell. Although if I was in trouble and I could, keep some of my gains, I would. If it was more house than I could afford and I needed to downsize, then I probably would, unless there was going to be a way to keep it in the family or to do multi-generational housing. Multi-generational housing has become a huge trend. In fact, that's why the average house price has gone so high, is because we're selling bigger houses because families are moving in together. It's not due to inflation. If you've heard that, it's someone trying to sell you into something, probably cryptocurrency or gold. So finally, for your nest egg, it's as simple as once, twice, or 3 times a year, draw up a pie chart of what you should have using my free web app. Draw up a pie chart of what you do have using an Excel file. And if the slices are too large, sell high. And if they're too small, buy low. It's that easy. When you're doing something that you have to babysit, some kind of hot or an individual company, then ask yourself, what can the company do? What can the industry do? What is the market going to do? And that can help you to decide when to buy low or sell high. Also, using the slice system can help you, because if your slice has become 10 slices, sell high and trim it back to a slice or two. Keep your money, and it gives you the emotional fortitude to buy low. Remember that meme stocks have changed the game. So when people start going crazy about a particular company on Reddit, then that could make it shoot the moon, which would be much higher than you might have anticipated. It may only stay there for an hour or two. So you might have on your smartphone an app that tracks stocks for you. And if you are babysitting, babysit. Don't have 200 companies. You wouldn't have 200 children that you're babysitting. You can't babysit 200 stocks. So only be very selective and only the hottest ones. All right. I hope this has been helpful for you. Again, we cover all of this in our investor educational retreats. The next one is October 9th through the 11th. And if you register by Sunday, you get the best price and a free coaching session valued at $300. We'd love to have you. Also, adding in more people, it's going to be the lowest price. In fact, 2 or 3 people are able to come to the online retreats for the same price one person at the in-person retreats. So now is the time to really empower yourself and your family. Okay, so I'm going to stop the recording, and if anybody has a question, I'll open up the phone lines. We can talk about it. And obviously, if I think we all should be learning what this question might teach us, then I will absolutely record it. So you guys will be able to watch this back at youtube.com/Natalie Pace. You can share it with anybody you like. It's absolutely free. It's a good idea to watch it back because there's a lot of resources in there. I'm telling you, I'm linking you to blogs and asking you to check them out. I'm pointing you to books and sections of books that might be helpful to you. But the bottom line is this is a recovery year. It's a gangbusters year, but it's still no excuse to just ride up and down. The Wall Street roller coaster has cost too much in the past recessions, and this one is the worst and most challenging time, even with the 6.5% GDP growth, because of all the debt, because of 5 million people who haven't paid rent or their mortgage, because of many corporations that are near junk bond status, which means they're vulnerable to having to declare bankruptcy to restructure their debt. That means that your bond portfolio could be a lot more risky than you're realizing, and you're not getting paid for it. When you add in the fees, you might be losing money. So 310-430-2397 or email us at info@nataliepace.com if you're interested in a second opinion or learning more about the retreat or registering for the retreat. Thank you for joining me. And as always, I will be seeing you at least in July. Try to do the video conferences at least once a month. You may see me one more time in June. All right. Have a lovely evening. Have a wonderful weekend. Enjoy your summer, and I'll see you soon.